Folks, I don't know if you've heard, but delinquencies on residential mortgages are up. And if you do it on a percentage basis, you could even say something like they're up 30%, which again, when you use small numbers, the percentages seem kind of scary. But what I thought I should do with someone who went through the last cycle as I did, I thought we should jump in our time machine and just remember what actually happened last time, because there are some doomers out there talking about this delinquency spike being the second coming of the Great Recession and a Category 5 hurricane is amongst us. That makes for great videos, I guess, but I'm not sure it is reality. Anna, we went through the GFC last time. We saw it up close and personal. It was painful and frankly something I never hope to experience again. The level of pain and suffering that I saw around me was next level.
Right.
And it was years in the making. And I think a lot of people talk about the crash as a moment. It was not a moment. It was years and years in the making, and then years and years to resolve. So when you think about delinquencies spiking and you kind of put your old GFC experience on, my memory says it started in subprime, but there was a lot of contagion after that. But what do you remember about, the beginning of the pain last time?
Sure. A great question, because I've learned so much from what I didn't know at the time that really, caused us a lot of pain because we were not prepared. But at the time, I remember, real estate kind of peaked in 2006, but you never know when the peak is till you look back in hindsight.
Yeah.
You can tell we got close, or we were close to a recession, or there were recessionary conditions, but until it's declared and you go, wait a second, here's the formal peak and here was the formal recession. There were 2 to 3 years between those points, and many things happened very, very, very slowly in that 2 to 3 years. When we look back at the GFC and we see real estate actually peaked in 2006, people were still buying as if it was the peak in 2007. I know I was, right? People were still borrowing money. I bought a building in 2007, 100% financing. The lender gave me 90% and let me open a credit card to put the other 10% on. That's the kind of financing that was there, despite the fact that we had just crossed a peak. We got SBA loans to start new businesses. And so I thought the economy was doing great. And although there were some news articles looking back that said, hey, there's a warning here, we need to be careful of this. Real estate's hitting a peak, values are unsustainable. Like, there were warning signs, but people kind of ignored them because things kept floating along in the economy for a while. And I see some of those same things now, Michael, is that because there's been all these warnings, like you and I have been warning for over a year and a half now, like pain is coming. We need to prepare for a recession. We need to prepare for hyperinflation and the Fed having to raise rates. It's been a slow churn, and the market's still going up. Things are so disconnected from fundamentals that people have hope that everything's going to be fine and we're just going to have this soft landing and the Fed is going to win and there's no pain. I think the risk of that is thinking that because the pain didn't happen quickly and deep, that no more pain is coming. And that's what happened in 2007 and early 2008, is that people just thought the economy's strong enough to weather some of these, problems. And all of a sudden, it seemed like suddenly the week that Bear Stearns and Washington Mutual and AIG went under was the first time, and this was early 2009, that I realized, whoa, we really have a problem. But if you go back and you put your hat on and look backwards, you see that the problem was 2.5 to 3 years in the making. So that is, I think, at a high level, what I would say about today. So when you look at these numbers, like where are delinquency, they're a little dot on the pivot of on the story, on the plot line that says, here's an indicator of something being a little more painful than it was yesterday. So we looked back last time we talked, and homeowner delinquencies were actually at historic lows. They weren't really ticking up yet. But if you look at auto delinquencies and you look at credit card delinquencies, they're way up. If you look at corporate bankruptcies being declared, they're way up. But housing has been pretty resilient. So housing being, the delinquencies being up, alone wouldn't worry me that much because you're comparing it to last year, which was an all-time low. And
Right.
so anything off of an all-time low is going to be a big percentage, even though the number may not be that many. But when you add that there are starting to be some delinquencies in the greater pictures of personal delinquencies in loans and credit cards, which is where everybody else has their money,
Mm-hmm.
their
Yeah.
loans, and then corporate delinquencies, and then all these other coincident indicators and leading indicators that show us we are in recessionary territory on just about everything else. It's another point that says there's more pain ahead than what
Yeah.
most people are thinking.
I agree 100%. And again, we've been trying to raise the yellow flag for at least a year. Um,
Yes.
I think commercial real estate is the most obvious. And actually, I had a conversation with Ken McElroy. You can find it on his Spotify podcast. And I'm like, Ken, dude, I can't believe that the commercial market repeated the same mistakes as residential, right? Bad assumptions, bridge debt, which were 2-year neg am last time in resi. The similarities were shocking, and he agreed with that.
Yes.
Um, but when we go back to residential, I think you brought up a very interesting point. Is it's a slow burn, right?
Mm-hmm.
It's not an event, and
Yes.
I certainly it would be inaccurate not to identify the lending standards today versus 2006, right? You just
Right.
highlighted you did a deal with 100% leverage. Those deals aren't getting done and haven't been getting
Right.
done, right? You couldn't do that today. So
Right.
the underwriting is very different. Neg am loans are frankly illegal now, and they were.
Yes.
I mean, so there are some sins that were committed last time that weren't committed this time. So net,
Right.
good thing.
Yes.
The other thing that I think is very interesting, and you just highlighted it, and I think a lot of people are missing it. Shelter is the third thing, and what is it? Maslow's hierarchy of needs, right? Water, food, shelter. And if you look at the shelter component, again, right or wrong, the effective interest rate along all mortgages is 3.6%. If you add in the 30+% that are owned free and clear, the effective interest rate is, something in the twos when you blend
Right.
that all together, right? And so when I look at this, and I agree with you, I think the consumer is stretched. I don't think the consumer is nearly as strong as some of the data is. We get retail sales tomorrow, so I think we'll have a better view. Credit card
Right.
balances are over $1 trillion for the first time. Credit card delinquencies are spiking. Car delinquencies are
Yes.
spiking. So not a lot of good there. But when you're a
Right.
family and you're sitting at the kitchen table and you're like, what are we not going to pay? Because again, I got to remind folks, this is a memory I have. I think I was 10 or 11. I go in our kitchen. My mom is sitting at the table, and she's looking at envelopes of different colors. Because back in the 80s, when you were delinquent, you would get different colors. Like, I don't remember what they were. Like pink is the first time, yellow the next time, or whatever the colors were. I remember it is vivid today as 30 or 40 years ago. There are people making those decisions today. So when you think about it, I think credit cards are the easiest thing to go up. We're not paying that one. Then it's car loans, and then it's shelter. And again, assuming you're the predominant person out there and you didn't just buy in the last 7 seconds, your effective interest rate's in the threes. You got to live somewhere. You have family. Maybe you get room. I mean, there's unemployment. Unemployment's going to pay folks enough to probably pay their mortgage if you got it in 2020 or 21
Right.
or 2020 and 2021. So when I look at the residential space, yes, delinquencies will go up because they have to from an all-time low. They are still below historical averages, which coincidentally
Yes.
nobody talks about.
Way below.
Yeah,
Mm-hmm.
I just don't see. I think there will be so many signs coming. And oh, by the way, the biggest elephant in the room, mortgage lenders have learned that foreclosing on everybody is bad. Extending and pretending via forbearance is good. So if we got to a
Yes.
time where delinquencies tripled, quadrupled, quintupled, You don't think they would just roll out that 90-day, forbearance period again? Come on, really? Are we not going to pretend that that's what they're going to do? So
Right.
those are kind of my thoughts when I look at all of this.
Yeah, I agree with you there. And it's one of the reasons that I don't think, although I think that there's more pain ahead, I might call it a category 3 unless some other exogenous
Yeah,
factor makes it turn into a
two
category 5
storms
really
merged
quickly,
together.
which we've seen that can happen,
That can
multiple
happen.
things. I mean, war and pandemics and, all kinds of things can happen. OPEC cutting, supply
Yeah.
when prices, just as prices are coming down. There's things that are very complicated that can push us off a cliff very quickly or turn that category 3 into a category 5. But when people are looking for a category 5 and hoping that home prices are going to plummet and you can scoop up properties dirt cheap, I don't see that piece happening the way that it did in 2008, because to your point, in 2008, you had all of these variable rate loans that were coming due, pushing everybody's home payment much, much higher. And you had overbuilding and hyper supply in many, many, many areas. And so when you add those two things together, you really had a peak that had to come down. Both there was too much supply, then people were foreclosing, they were losing their jobs, and there wasn't enough demand in lending. So we don't see the demand in lending because of rates going up and lenders cutting back their underwriting for only the best quality buyers, essentially. But the Fed killed supply. And so when you have 2.6 to 3.6% effective interest rates, and that's still below inflation, you're making money by keeping that mortgage and staying in your house, really, on an inflation adjusted basis.
You
And
are.
so nobody's going to sell that house unless they have to. So it's where is the consumer in terms of the distress, and how is that relative to all the other people in their area? Because if you're in an area that, let's say I'm going to pick on Detroit, that was like Detroit, where the entire auto industry left, and so everyone lost jobs. So in that area, there was a major increase of supply. Unless you have something like that happening in a particular sector or a particular area that really doesn't have a lot of employers or diversity in the industries of the employment, those areas could still hit something similar to 08 and 09 if major employers leave and then they have to move. But barring that, if you're in an area that has a lot of diversity in terms of employment options, like you said, you might lose a job, but you go on unemployment and you can probably still find another job. So you're only really going to have people that move for divorce, death, and job relocation for the most part. Most people are going to say my home is my only asset. And if I have to declare bankruptcy to wipe out credit card debt and car loans and, anything else, they won't lose their house as long as they keep paying their house payment. So I think supply stays low relative to demand, or at least flat. And that's going to keep us from having a major housing recession when it comes to house values plummeting. Although, if the economy gets worse and worse and worse, and we start to see a lot of, corporate bankruptcies, which I still think could happen,
For
and
sure.
a lot of banks starting to continue to experience pain, that could cause those unemployment spikes that could cause more people to have to move for jobs. And it could start depressing prices a little bit if you have an uptick in supply as a result. So don't think the pain is over. Don't
Oh
think there's going to
no.
be no dip in housing values. There isn't, as long as people aren't incentivized to move and sell, and as long as rates are high relative to what they have today. But there could be more pain ahead, and I expect that there will
Yeah.
be. And within that, there will be pockets of opportunity. So you need to look at, where are the distressed sellers? Where are the motivated sellers? How can I create win-win deals that helps them out of a difficult situation and also allows it to make sense for me financially to do the deal?
Yeah. At the end of the day, having gone through the last crisis and see what's kind of festering today, in the last crisis, you were sitting around the kitchen table, back to my mom doing that in the 80s. The house was the option. You had to let it go, right? You probably had a variable rate loan. It went
Right.
from $1,000 payment to 3,500. Rent, a rent equivalent at the time was 1,200. So, while the teaser part of that loan was there, it was easy to stay. But at the end of the day, when your mortgage payment goes from 1,200 to 3,600 and rent's 1,500, you move. And oh, by the way, strategic default became a game, right? They defaulted. Dude, Anna, people don't remember this. The banks told you they couldn't work with you for 90 days. So people didn't
Mm-hmm.
pay for 90 days.
Right.
Then, yeah, it's shocking, I know. And then people were in their homes for years not making payments. They were waiting to get kicked out. They didn't get kicked out for years.
Right.
So, yeah, and that was before forbearance and all these other loan workouts and all those other things. So, even, there's pain coming. I called a recession starting in Q2 and was wrong. Q3 looks to be over 5%. So no recession starting in Q3. I just think the decisions are different. Looking at my mom as a 10-year or 11-year-old, she's like, in
Yeah.
2009, 10, well, I guess we're not paying the mortgage because that's all our income.
Right.
Today, it's like, dude, we got to stay here. This is a stupid payment that's 30% below rent. So we got to live somewhere, and I'm not living with my mom, right? We're going to live here. But you know what? We're not going to pay our credit cards. Screw those people. We're not. We
Right.
can get a cheaper car. We didn't need to ball out during the recession. We'll go get a used
Yeah.
car, or we'll get a
Right.
scooter or something else. So
And
I just think,
honestly, if somebody has a home and they can afford their home payment and they like where they live, I mean, I never advocate bankruptcy, but someone's not going to care if they have a short, hit to their credit, but they're just never going to have to move. And so then
yeah,
they don't care as much about their credit because they don't have to apply for another mortgage. So, I could see a lot of people declaring bankruptcy, wiping out this debt, but staying in their home, versus last time letting the home go because it was their
oh,
biggest
it was the
thing, and they
liability
were
last time.
upside down in values, and now
Oh,
now they're not upside down in values,
yeah,
at
they
least
were
at this
upside
point.
down in values and in rent versus own. That's what a lot of people are like. Hey, it
Right.
makes no sense to own today. But dude, there are people that bought 2 years ago. It makes perfect sense to own. Right? You guys are twisted
Yes.
on your timing, and
Right. And
that's
it
what
is
I.
hard. It's
Yeah.
hard to read the signs because, Michael, they're so disconnected from the fundamentals. So even when you look at real estate cycles and you go, here's a peak, and then you come down, and then you have recession and you bounce back up, those peaks are normally accompanied by hypersupply. And we don't have hypersupply. In most markets, we're
The,
undersupplied.
the Fed
Um,
broke housing, Anna. I don't know if you've heard that.
Absolutely. So we're in a housing recession in terms of transactions, but we're not in terms of values. And I was reading something today where, a big economist says we're actually in recovery now, heading back toward peak once the
I,
Fed
I
corrects, instead of
I read
we're
that.
in recession. So, employment is still high. GDP is still high in certain sectors. But if you look at all the coincident indicators, I keep going back to that the NBER looks at to date recessions, all of them except employment are recessionary. So they've all fallen, whether we declare a recession or not. How can you have deep recessionary conditions and also high GDP at the same time and low unemployment? Because we're disconnected from reality
Yeah.
because of COVID, and then the stimulus afterwards made a really painful economy feel like we didn't have pain anymore and stimulated people's spending. So it's
Mm-hmm.
really hard to figure out where are we and where exactly is it going, because we're disconnected from the fundamentals of a free economy without Fed manipulation.
I,
And so, I think there's more pain coming, to your point, but I think homeowners stay put. And I think that that's
yeah.
going to keep us from having a tsunami of values crashing, at least in general across America. Although you will have pockets of pain,
Mhm.
I think for some areas that were oversupplied, like with spec homes and build to rent by these big funds, if they built homes all in that area and they suddenly have to sell for a discount, that could cause values in those areas to really come down and have some big opportunity for investors. But I just don't see massive pain to the consumer that causes them to, give up their house or go into,
There's
foreclosure on the
just
home when it's their
yeah.
biggest asset and safety net.
Yeah, there's just unlike last time, and I think this is a lot of what the doomers are missing. The last time the housing was the first to go, it made economic sense. It was a
Yes.
good financial move to let the house go first. In today's environment, for most people, it'll be the last thing to go because it is a
Yes,
bad financial move. And I think that is
I agree.
remarkably different. Anna, where can people find you?
Great. You can find me here on the show, and you can find me on social media at Anna Kelly REI Mom, and my website at reimom.com.
Thank you so much.